Something just broke in the silver market. And I don't mean a technical line on a chart got crossed. I mean the actual machinery that has controlled and suppressed silver's price for over a decade is now visibly coming apart in real time. This week, silver crossed $77 an ounce. That's a significant move by any measure. But the price itself is almost the least interesting part of what happened. What happened beneath the surface of that price move is what should have every serious investor paying close attention right now. Here's the thing about a real breakout in any market. When price breaks through a major level, you get a flood of new participation. Traders pile in, volume surges, open interest expands. The market gets louder and more crowded because everyone wants a piece of the momentum. That's how breakouts work in a healthy, functioning market. This week's silver move looked nothing like that. Silver ripped higher, while the futures market that supposedly controls its price collapsed to its lowest participation level in over 15 years. Traders weren't arriving, they were leaving. The casino was emptying out while the jackpot was being hit. And that combination tells a story that most analysts are completely missing. But before we get into the full breakdown of what the data is showing, I need to tell you about something that happened this week in the Middle East, something that almost no one is connecting to silver's move, a development so significant that it could be the actual trigger behind everything we are about to walk through. A major oil-producing nation formally notified the United States Treasury Department that it may begin selling oil in currencies other than the US dollar. By the time we reach that part of today's breakdown, every data point we walk through before it will snap into perfect focus. Stay with me on this, because the full picture here is extraordinary. Now let's start with the price action. Silver pushed above $77 an ounce this week. Just days before this move, the metal had been sitting in the low 70s, grinding sideways, looking like another consolidation phase that bears could lean on. The chart had been compressing inside a multi-month tightening triangle. Lower highs, higher lows, the price coiling tighter with every passing week toward a single decision point. That decision point broke this week. Technical traders have a name for this pattern. They call it a coiled spring release. The logic is simple. The longer a market compresses inside a narrowing range, the more explosive the eventual breakout tends to be. Silver had been coiling for months. The release just started. But here's what separates this move from every other silver bounce you've watched fizzle out over the past several years. Previous rallies happened while the underlying futures market was still functioning more or less normally. Traders were present, liquidity was there, the paper machinery was intact, even if the price direction was frustrating. This rally is happening while the paper machinery is actively breaking down. And the data that reveals that breakdown is something every serious investor needs to understand. The number that stopped me this week wasn't the silver price itself. It was the open interest figure. Comex silver open interest dropped another 3,300 contracts in a single trading session. Total open interest now sits at just under 96,000 contracts. To put that in plain English, open interest is essentially a count of every active position in the silver futures market at any given moment. It measures participation. It measures how many traders, speculators, hedgers, and institutions have live exposure to silver through the futures system. When open interest is high, the market is deep, liquid, and functioning. When open interest collapses, participation is dying, the market is being abandoned. 96,000 contracts is the lowest that number has been in over 15 years. A decade and a half of market history, and we are now at the bottom of the participation range. But it gets worse. Volume on the same day came in at just 35,000 contracts. In recent years, healthy daily volume in this market regularly crossed 80,000 to 100,000 contracts per session. Volume just got cut by more than half. The bid is gone. The room is empty. Now think carefully about what this combination actually means. Silver price is breaking out higher. Open interest is collapsing to 15-year lows. Volume has been cut in half. In a normal market, these three things cannot coexist. Price breakouts bring in new participants. New participants expand open interest. Expanding open interest drives volume. That's the standard pattern. This is the opposite pattern. Price is rising while participation is falling. And that inversion tells you something critical about who is actually doing the buying right now. The buyers are not paper speculators. They are not momentum traders chasing a breakout on the futures board. The buyers are physical, refiners locking in supply, manufacturers securing inventory for production pipelines, sovereign wealth funds quietly accumulating outside of Western exchanges, bullion banks scrambling to cover short positions they can no longer defend, Eastern exchanges absorbing metal that Western paper institutions can no longer hold. Paper traders are walking away from a sinking ship. Physical buyers are pulling the actual metal off the table. That is why silver can explode higher at the exact moment when paper market participation is dying. It is the signature of a paper-to-physical demand shift happening in real time. And this shift has been building for years for reasons that go well beyond any single week's data. To understand why the paper market is dying, you have to understand what killed trust in it. The Comex and its parent exchange, the CME, have spent years implementing what analysts have described as targeted interventions every time silver approached a major breakout level. Margin hikes timed to crush long positions at critical moments. System issues and so-called technical problems that mysteriously surfaced during silver's most explosive trading. Sessions, effectively locking buyers out at the worst possible time. Exchange rule changes implemented mid-move that altered the terms of existing positions. These interventions happened consistently enough and with suspicious enough timing that a significant portion of the professional trading community drew one conclusion. The rules of the game were being changed specifically to protect large short positions held by a small number of major bullion banks. And when traders reach that conclusion, when the fundamental trust that a market will treat all participants equally evaporates, they stop coming back. They do not announce their departure. They simply stop showing up. Open interest declines, volume fades, liquidity dries up. And eventually the market loses its ability to perform the one function that justified its existence, which is price discovery. That is the stage we have reached. If you're following this breakdown, hit the like button on your way through. It helps recession warnings reach more people who need to see this data. And drop a comment below telling me where you're watching from. We have viewers tracking this story from across the country, and I want to know where the recession warnings community is concentrated right now. The third piece of evidence that confirms this picture came through the contract rollover data. When the May silver futures contract closed out this week, open interest in that contract dropped for 700 contracts, settling at just over 2,500. In a functioning futures market, when a near-term contract winds down, the vast majority of participants who held positions in it simply roll their exposure forward into the next active contract. They don't exit the market, they just shift their positions out along the calendar. That roll happened this week in the most anemic way anyone has seen. July futures, the next active contract, gained just over 1,000 contracts, not even a quarter of what should have transferred. September gained just 20 contracts, 20. The math is stark. Most of the traders who held May silver positions did not roll forward. They walked away entirely. Either they took physical delivery of actual metal, or they exited paper silver exposure altogether. This is what a paper market looks like in the late stages of losing its relevance. Participants are not just refusing to enter new positions, they are declining to even maintain forward exposure. They no longer want their capital sitting in a venue they consider structurally compromised, and the rollover data makes that conviction impossible to ignore. Take all three signals together: silver price breaking above $77, open interest at 15-year lows, near-term contract participants refusing to roll into forward months. This is not a healthy market having a bullish episode. This is the structural unwinding of a price discovery mechanism that has dominated silver pricing for decades. The Western paper price model worked for one reason. It required enough participating traders to maintain the illusion of deep liquid markets. As long as enough players kept showing up, the system could absorb physical delivery pressure, suppress price spikes during periods of stress, and keep silver trading well below what its fundamental supply and demand picture would otherwise support. Shrink the pool of participants below a critical threshold, and the mechanism loses its grip. The price gets free. That threshold appears to have been crossed. You might be asking yourself a reasonable question at this point. If silver is breaking out and the paper market is clearly deteriorating, why is the mainstream financial press barely covering any of this? Why is this not the lead story on every financial network? The honest answer is uncomfortable. To explain what is actually happening in silver right now, you have to acknowledge that price discovery in this market has been compromised for an extended period. You have to discuss the documented history of bullion bank short positioning that runs into hundreds of millions of ounces. You have to address the pattern of exchange interventions that repeatedly reset the board every time silver approached a genuine breakout. Most major financial outlets will not have that conversation. Their institutional advertisers, their banking sources, their entire relationship infrastructure is built on not asking those questions publicly. So the data sits there in plain sight, in the Comex reports, in the open interest figures, in the rollover statistics, waiting for anyone willing to actually read it. And right now, the data is not whispering. It is screaming. Silver up over $4 in a single morning. Open interest at the lowest level in a generation. Volume less than half of normal. May contract holders refusing to roll forward. Eastern exchanges pulling physical inventory that Western paper markets can no longer retain. Every single one of those data points is independently significant. Together, they constitute the textbook signature of a market in the early stages of a major structural repricing. But understanding why this is happening now, why this particular week became the visible crack, requires looking at a story unfolding several time zones away from the Comex floor. This is where the picture becomes genuinely historic. This week, the United Arab Emirates officially exited OPEC. Let that land for a moment. A major oil-producing nation, one of the largest energy exporters in the world, one of America's closest and most strategically important partners in the Middle East, formally departed the cartel that has controlled global oil pricing for half a century. That alone is a geopolitical earthquake. But the UAE did not stop there. They sent a formal notification to the United States Treasury Department stating that they may begin selling their oil in currencies other than the US dollar. Read that sentence again carefully. A formal notification to the US Treasury. Not a rumor. Not a diplomatic trial balloon. An official communication from a sovereign nation to the American government, signaling potential departure from the arrangement that has undergirded the dollar's reserve currency status for over 50 years. This is the petrodollar system. And it just took its first formal crack from the inside. To understand why this matters so profoundly, you need to understand what the petrodollar deal actually was and what it has meant for every American's financial life. The arrangement was constructed in 1974 following the collapse of Bretton Woods and the end of dollar-gold convertibility. The deal was straightforward. OPEC nations, led by Saudi Arabia, agreed to price and sell their oil exclusively in US dollars. In exchange, the United States provided military protection, security guarantees, and preferential access to American weapons and technology. The consequence of that deal was enormous. Every nation on Earth needed dollars to buy oil. Global energy demand created permanent, structural, non-negotiable demand for the US dollar, regardless of how much the Federal Reserve printed or how fiscally irresponsible Washington became. The dollar did not need to earn its reserve status through discipline. It was enforced through the energy market. Every central bank on Earth had to hold dollars. Every trade settlement passed through dollar-denominated systems. The entire architecture of global finance was built on that foundation. That foundation is now cracking. And the implications for every dollar-denominated asset in existence, including your savings, your retirement accounts, your mortgage, your cost of living, are not abstract. They are direct. They are already being felt. Every round of money printing that produced the inflation of the past 4 years was ultimately possible because global dollar demand absorbed the excess. As that demand softens, the cost of maintaining the dollar's purchasing power rises. The inflation you have already experienced is the early symptom. What the UAE's notification represents is the beginning of a structural acceleration of that process. Now here is why this is not just a dollar story. This is specifically and directly a silver and gold story. When the petrodollar system weakens, the nations that have been required to hold US Treasury bonds as their primary reserve asset start asking a very different question. Why are we holding paper claims on a currency that is being actively debased and that has already been weaponized against sovereign nations? Russia's experience in 2022 answered that question for every central bank on Earth. When Western nations froze over $300 billion in Russian foreign reserves overnight, every non-Western central bank got the message simultaneously. Dollar reserves are not safe. They are a political instrument. And the response was immediate and structural. Central banks globally have been net buyers of physical gold every single year since 2014. After the Russian sanctions hit in 2022, that buying went parabolic. Gold purchases by global central banks multiplied roughly 5 times in the years following the sanctions. China has been steadily reducing its holdings of US Treasury bonds, offloading roughly half of its peak position over the past several years. The structural shift away from dollar paper assets and toward physical monetary metals is not a forecast. It is a decade-long trend that is now visibly accelerating. And what the UAE's OPEC exit and petrodollar notification does is add formal, official, sovereign momentum to a shift that was already well underway. If even a fraction of global oil settlement migrates from dollars toward gold-backed alternatives or bilateral currency arrangements, the math for precious metals becomes extraordinary. The annual global oil market runs at roughly $3 trillion in production value. The annual gold market runs at roughly $236 billion. Those markets are not close in size. If just 5% of global oil settlement shifts toward gold-referenced pricing, the demand increase relative to the size of the gold market is not manageable through gradual price adjustment. It forces a repricing event. And silver, as gold's smaller and more industrially critical partner with a physical float that is genuinely constrained, with a manufacturing demand base built into semiconductors, solar panels, medical devices, and defense systems, with a paper suppression mechanism that is now visibly failing. Silver in that scenario does not move in steady increments. It reprices in jumps. This is the macro backdrop behind this week's $77 breakout. The petrodollar is developing visible cracks for the first time in 50 years. Central banks are accumulating physical gold at generational highs. The US Treasury market is losing its largest foreign holders. The structural pressure on the dollar's reserve status is unprecedented in the post-Bretton Woods era. And the silver paper market, which served as the primary mechanism for keeping the metal priced well below its fundamental value, is losing participation at a historic rate precisely when all of these macro forces are converging. The $77 print this week is not a random technical event. It is the first visible price reflection of a much larger monetary reset that is now underway. Veteran technical analysts covering precious metals have published silver price targets ranging from $350 to $500 based purely on the chart structure. Analysts covering the macro monetary picture have published gold price targets between $7,000 and $9,000 based on the structural dollar dynamics we just walked through. Major institutional players, including firms that previously dismissed the precious metals thesis, are now publicly reversing their positioning and issuing bullish calls. The institutional cover for this move is now present. The macro backdrop has just received its most significant confirmation in decades. The data from the Comex is showing the paper suppression mechanism breaking in real time. Most people who own no silver and no gold will only understand what this transition meant after the prices have already moved 50, 100, 200% higher. That is how these structural repricing cycles have always worked throughout monetary history. The signals are present and readable right now for those paying attention. The data is not hidden. It is published every day in the Comex reports, in the Treasury data, in the central bank reserve disclosures. What is missing for most people is not access to the information. It is the framework to understand what the information means and why it connects. That is what recession warnings exist to provide. Not predictions, not financial advice, not guarantees. Just the data, the context, and the connections that the mainstream financial press either cannot or will not make. This week, every major piece of that picture aligned simultaneously. A paper market breaking down, a petrodollar arrangement cracking publicly for the first time in half a century, a price breakout happening on the lowest participation the futures market has seen in 15 years. Where you go from here with that information is your decision to make, but you now have the full picture in front of you. If this breakdown gave you something valuable, hit the like button before you go. It is the single most effective way to help recession warnings reach more people who are trying to understand what is happening to their financial lives right now. Subscribe and turn on notifications so you don't miss the next breakdown as this story develops. And drop a comment below telling me where you're watching from. I want to know where this community is. See you in the next one.